What's up you guys, Joe here from the Average Joe Investor channel where we help the average Joe become financially independent. In today's video, we're talking about downside protection in our investment portfolios. Within the last 3 years, Nationwide came out with an actively managed ETF, the Nationwide Nasdaq 100 Risk Managed Income ETF, NUSI. And this ETF was unique because it offered downside protection as part of owning the ETF. And since then, GlobalX has also come out with 2 ETFs that do something very similar but have some unique differences. In this video, I'm going to break down for you the differences between NUSI, GlobalX's QRMI, and GlobalX's Xrmi. We're going to understand the fundamental differences between the 2 ETFs, and then we're going to plug them into my spreadsheet based on the data we have available to see how they perform, yes, but also to see the differences between them when it comes to market fluctuations. So we'll also compare it to the S&P 500. Hopefully you find some value out of this video and it informs you on potential future changes to the portfolio. For me personally, it actually made an adjustment as to how I invest my emergency fund. You guys know I never want to waste your time and I always want to deliver massive value with every video that I make. So without further delay, let's get started. All 3 of these ETFs operate similarly in that they do 2 big things. These funds are known as collared ETFs because they are selling call options against the upside of the market, and then they are also purchasing a put option, which is protective. It's a protective put, meaning that if the market goes down, the value of that put option goes up in value as well, which mitigates the losses of the portfolio. Here's essentially what it breaks down to: a protective collar option strategy. With the call option, your growth is capped right here. There's also the income being generated from the ETF, and then on the downside here with the put option, it means that you can't fall below here with risk. At this point here, your risk is capped. We'll get more specific on how this strategy is implemented by all 3 of these ETFs, but let's talk about the differences here. Both NUSI and QRMI have an underlying index that is the same, the Nasdaq 100, whereas Xrmi from GlobalX utilizes the S&P 500 as the underlying index. You can see it right here. This is on the QRMI website. Employs a protective net credit collar strategy, seeking the income characteristics of a covered call fund like QYLD while mitigating the risks of a major market sell-off with a protective put. It owns the stocks on the Nasdaq 100 index. And then we've got Xrmi, the S&P 500 Risk Managed Income ETF. Same idea, it's literally the same text here, and then it says it seeks to achieve this outcome by owning the stocks on the S&P 500, which is the SPX index. And then again, we saw right here, NUSI purchasing the underlying stocks in the Nasdaq 100 index. A few differences here. NUSI has an expense ratio of 0.68%, whereas Xrmi has an expense ratio of 0.60%, and QRMI, same thing, 0.60%. Now let's talk about those unique differences in the net credit collar strategies. All 3 own an underlying index, and then all 3 of them are also selling a call option, which generates income. And then on the downside, they are all 3 purchasing a put option, which will cost money. And when these ETFs say net credit strategy, it means that between selling the call option and buying the put option, there is still money left over. It's a net credit to you, excess money left over as the option writer. With a net credit strategy, it means that after selling the call option and buying the put option, there was more money generated from the call option than the put option, and that's where that monthly income is going to be derived from, because all 3 of these ETFs generate a monthly dividend for investors. Now, how these strategies are deployed are different between the ETFs. With both QRMI and Xrmi, they are very explicit in their rules-based strategy. With both QRMI and Xrmi, they will be selling options right here at the money. Let's say this price here was actually $23 even at the beginning of the month. What they would do is they would sell a call option right at $23, which will generate the most income possible. It will generate the most premium from that call option. And then what they'll do is with that money, they will use a portion of it and they will purchase a put option below the market. It says right here, they will purchase a 5% out of the money put option. They give this example right here. Hypothetically, if the price was $50, they would sell a call option right at $50, which would generate the most income. And then for their put option, the price that they would purchase the option would be at $47.50, which is 5% out of the money, which means that you will potentially lose money, but it will be capped at a 5% loss here. So if the market were to sell off 10, 15, 20%, your max loss would still only be 5%. Plus the fact that you actually were getting income from the fund as well. Same thing here with XRMI. Selling an at-the-money call option, purchasing a 5% out of the money put option. What I really like here about GlobalX is they're very explicit with their rules. It's very straightforward. Every month they're going to sell an at-the-money call option, which generates a lot of premium, and then they're going to use some of that to purchase the put option, and the rest of it will be distributed to shareholders. NUSI, though, honestly, is a little bit different. Scrolling through their website, I found it very difficult to find any information on exactly their strategy. Here's what I was able to find in their white paper. As part of their strategy, they write covered calls on the Nasdaq 100, strike prices near at the money or slightly out of the money, meaning that potentially they're going to generate less premium than by selling at the money. Again, when we talk about in the money, out of the money, at the money, when we say at the money, it means that the strike price is right here at the price that the stock is trading at right now. Whereas out of the money means that, let's say the price is currently $50 a share, it means that that option will be sold at 55 or 53 maybe, above where it's trading right now. Meaning you'll still be able to participate in some growth, but you'll still generate option premium by selling the option, just less than if you were selling an option right at the money. Also, it says here that if for some reason the price rises rapidly and it rises above the strike price on that option that they sold, then the manager may close the call option early to minimize potential losses. And then it talks about purchasing out of the money puts here. They're not very specific on what price they purchase at, but I've seen elsewhere that it's between 5 and 10%. So there's a little bit more downside risk with NUSI. NUSI reserves that discretion to change how they buy and sell their options, which for me is, I don't know if I like that so much. I get that maybe that could result in outperformance, but I like the very clear and straightforward rule strategy that the GlobalX funds use. I also like how there is very clear transparency on the GlobalX websites for their specific options that they hold right here, both the long option, the one that they purchased, and the one that they sold here, the short one. I will link to all three of these ETFs down in the description below, but let's move on to the performance. Let's see how they actually performed. All right, so here's the spreadsheet, guys. We've got NUSI versus QRMI versus Xrmi. Now, admittedly, there's not a lot of data here. When we first talked about QRMI and Xrmi, they had just been launched. We had no data. With NUSI, we've got about 2 years. With Xrmi and QRMI, now we have since August 26, 2021 through January 7th. So still not a lot of data, but enough to see how the fluctuations month to month change the performance against NUSI and of course the S&P 500. Got all three of them here plus the S&P 500 just to see the differences in volatility. We'll be looking at a lump sum investment of $100,000. Not because I expect everyone to have $100,000, but just because I want to see the numbers at a larger scale, and we're going to see how if we had a lump sum of money sitting there, how would that change the results over time? We're going to look at cumulative dividend income, the overall portfolio value, and by popular demand, we finally have the total return tab here, which we'll look at as well for this time frame, August 26th through January 7th. We can see dividend yields here. NUSI's most recent dividend yield 7.83% versus XRMI at 8.83 and QRMI at 10.18. You'll also notice that the assets under management are vastly different here. NUSI still owns a massive percentage of this market share. All right, let's talk a little bit about dividend income first. Top dividend income here is from QRMI at $32.25 and 42 cents for the period, followed by XRMI at $29.51, and then followed by NUSI at $25.83. We fully expected the S&P 500 to be the lowest here, but it's just here just for tracking purposes. And then let's take a look at portfolio value here. Now it's important to note this portfolio value here does incorporate all dividends being reinvested back into the ETF. Of course, the S&P 500 in this time frame was up from 100 to 106, followed by XRMI, which was worth 101, followed by NUSI at 95,598, and then QRMI at 95,562. So we had two that lost money, and then XRMI was up along with the S&P 500. Let's take a look here at the portfolio value. We have all four of our funds here. This is the S&P 500. It definitely outperformed. There's some things here I'd like for us to take away though. Let's look at the XRMI and QRMI lines, blue and black. You'll notice, and then you've got NUSI in red here. Blue and black are definitely less volatile than the other two. You can see that red, the NUSI, is supposed to be less volatility, but you'll notice that the downs are lower, the ups are higher, and then here with blue and black, very straightforward through the middle here. Now, another thing here, when we talk about volatility, GlobalX has that 5% out of the money, whereas NUSI varies in how they utilize that put option. This most recent market drop that occurred here in the last 2 days, you'll notice that NUSI dropped a ton. It went from 99 down to, what is that? 96 in what, 1 day maybe? Maybe 2 days. Same thing with the S&P 500. It also dipped pretty strong right here, 108 down to 106. You'll notice that those fluctuations though with QRMI and Xrmi are very minimal. Same thing here with the downs right here. Much lower, much smaller reductions in the value with QRMI and Xrmi than we see with NUSI. And we have seen that there were some dips in the market. We saw it here in the spreadsheet here. The first, month and a half, the market was down overall, the S&P 500, QRMI, and Xrmi. What I've found though is that the stability of these ETFs over this short time frame compared to the others is exactly what I'm looking for when it comes to downside protection and still having my emergency fund invested and reinvesting those dividends. I previously have had my emergency fund in a combination of NUSI and QYLD, which was honestly a little bit riskier than most people would take. I really like the idea of the QRMI and the Xrmi funds. I might go a little bit heavier in Xrmi just for a little bit more stability here, but I just found that NUSI was still a little bit, had too much volatility compared to the other funds. So change to my emergency fund personally is going to be a combination of QRMI and Xrmi, and just let it set it and forget it. I'm getting rid of QYLD and NUSI from the emergency fund. Do you want access to this spreadsheet and all of the other spreadsheets that I use in all of my videos, along with other dividend content and access to the Discord community? Well, then you've got to jump into the Patreon community. There's a link in the description below if you're interested in learning more. Make sure to leave your 2 cents down in the comments below. I'd love to hear what you guys think, what your thoughts are on this video, and what other topics you want me to cover more in the future. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy both physically and financially. Have a good one.